In terms of precious metals, I frequently have said the reset is a process, not an event. And we are in the middle of that process now. The gold market is going to restabilize the dollar lower while it's going to restabilize against the yuan higher. So I believe that if you can be patient, you'll see that gold at 8,000 is not going to be a problem.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're digging into the red-hot world of gold, geopolitics, tariffs, and the global monetary system. I'm excited to welcome back Vince Lanci, professional commodities trader, publisher of the Goldfix Substack, and adjunct professor of finance at UConn, to the show. Vince is a trusted voice in the precious metals community, and we appreciate him coming on to Metals and Miners. Vince, welcome back to Metals and Miners.
Thanks for having me back, Gary. I appreciate you being patient with me from the last time. So thank you for having me back.
Absolutely. Absolutely. Okay, Vince, President Trump's recommendation of a 50% tariff on European Union imports effective June 1st explicitly cites a $250 billion annual trade deficit and what he describes as EU's exploitive trade practices. It's raised significant concerns within his administration. At the same time, the EU is delaying Basel III trading rules. I'm not sure if these are connected or not. What are the most immediate and profound economic ramifications of such a large and widespread tariff on the EU imports? And beyond even that, what are the broader geopolitical implications?
Wow, that's a great opening question. Current events, you're not going to let me hide it all, are you, Gary? All right.
No, you're the man for the job.
Fortunately, I'm paying attention to that. I don't know if I'm right, but I'm paying attention. All right. Starting with the direct implications of the tariffs, without getting into whether they're appropriate or not, and how the market digested them. And then moving on to, as you noted, the tie-in, whether it be intentional or not, to the bigger picture of the EU Basel III, which is, I think, a story that we actually almost broke in the West, except for Reuters. All right, so let's go with Trump. Trump comes out and announces 50% tariffs. You probably have the numbers better than me on this right now. And in doing so, in combination with the Apple comment, the comment about I'm going to put 25% tariffs on Apple for not manufacturing domestically. I think that's right. Stocks took it on the chin and nosedived. Right? The dollar weakened. Bonds rallied. We're not going to talk about bonds right now. And gold, of course, not of course, but gold really took it to heart and rallied very hard. Okay, without even touching on the Apple part, which is a whole other, put it this way, we'll just get Apple out of the way. The Apple comment says global recession. We're not going to do anything with anyone anymore. I mean, that's basically, it's bad for India, it's bad for us, it's bad for everyone. But the European tariff thing, I think has some other stuff going on. So you're right to focus on that. First of all, to tap into a little bit of the Tom Luongo zeitgeist. We are in my own flavor of it. We are in the process of divorcing from Europe, or let's put it this way, having some tough love with them over multiple issues. And it goes both ways. So first of all, just to start with Trump, because as a personality, I pretty much have him down, because I studied him in finance in New York years ago. And essentially, when he's got a big negotiation, he will come out and be bad cop to his buddies, Canada and Mexico. They're our allies. And he's bad cop to them. And at the same time, he's being nice to Russia and China. Oh, they're great. So it's kind of like he intimidates his friends, gets them on board. This is a negotiating style. And then after he does that, he hugs them. And then he turns around and he says, you're the bad guy. So now all of a sudden he's like, I'm not so happy with Putin. China's doing so. That's he turns his attention to them. The thing about Europe is Europe. He never really hugged out, and he never really attacked. But apparently, he feels confident enough. I don't know if the market feels that confident, but he feels confident enough that he can step in and lean into them in the whole bad cop style now. So, which brings us to the actual problems that are enveloping the relationship that we have with Europe. So, the first one is trade. They are more protectionist than we'd like them to be. Number one. Number two, the second one is, and this isn't corroborated, but I think Tom would agree with me, or maybe I'm agreeing with him, is that Europe in general, in the view of American conservative financials, is benefiting too much from the euro-dollar market. So let's just say that not Europe in general, the European banking system is very, very dependent on Fed policy because of the euro dollars that they have over there. All right. So now you've got if banking controls the blood flow of a continent, well then, and we control the euro dollar directly or indirectly, well then the whole euro dollar system has a disproportionate weight on Europe. And for the last 2 years, we've been cutting that out slowly, right? We went from LIBOR to SOFR. Those are the interest rates that govern, if anyone's not familiar with that. We just repatriated, a lot of gold. And repatriating that gold, whether we did it for ourselves or whether we did it for customers, it's irrelevant. We just took the gold and said, we want it back. We want it back. And there was no, we'll give you 30 days. We started taking it. And that's a serious lack of communication. We're not on the same page policy-wise. Europe keeps lowering rates, and we're not. So we're going separate ways monetarily, policy-wise. Fiscally, we're going separate ways. We are looking to, I'm not saying that we are, but we are looking to spend less, right? Europe absolutely needs to spend more now. Absolutely. So they have to defend themselves. They have to build their own military, et cetera, rebuilding Ukraine, whatever, what have you. So this whole backdrop that Trump is leaning into them on, Europe pushes back. Europe will constantly, one of the things that we do export to Europe is is technology. So Amazon, right? So shopping, what have you. And so they're accusing us of antitrust, right? They're suing Meta, Facebook, whatever. They're just anything that would hurt our trade, they're doing. So when you put those things together, and then Scott Bessent comes out after Trump made his statement and says, trying to explain Trump to normal people, well, we've been getting a lot of offers of negotiation with other countries. And President Trump thinks that Europe's is in bad faith. So Trump's like, okay, time to be a bad cop. Now, the Basel III event, that's another symptom of it. Trump, from a Republican point of view, is pro-deregulation for the banking side. Whether he succeeds or not, I don't know, but that's what he wants to do. So in that sense, if he's pro-deregulation, then there's a split in terms of regulatory governance. So usually in the world, Europe and the US are on the same page regulatory-wise. If it's illegal to do it over there, it's illegal to do it over here. Right? So gold is tier 1 over there first. It's going to be tier 1 here. And gold's a small part of it, but it's big for our community. So now Europe is saying, and this is the funny part, Europe is saying today, the news yesterday out of Reuters was, and we published was, we're worried about the United States not being on board with Basel III, and if they deregulate, it's going to leave us isolated in this idea. So basically, they're saying they're going to hold back on committing themselves and rolling it out. They pushed it out from 26 to 27. It meaning the basically the ability to look at banks' books. And in doing that, they are, I mean, you're giving me a lot of time to talk, so I'm going to stop in a second. In doing that, they are essentially blaming it on Trump, blaming it on the U.S., and what they're really doing, in my opinion, is they are hiding the fact that their banks are in bad shape. And I don't know the particulars, but their banking is not in good shape. So that's the 15-minute version.
Okay. All right. So let's shift here a little bit. Vince, you recently mentioned in an X post that the U.S. is likely going to tax capital flows as a means of balancing the trade deficit.
Yeah.
And in doing so, directly monetize its most valuable asset.
Right.
Would you unpack that regarding the capital flows, how you see that working, how it fixes the trade deficit? You also mentioned a Trojan horse part.
Yeah.
If you could explain that, and if you see any problems with that type of solution.
Okay, I don't know if I was drunk at the time, but I don't remember the Trojan horse part. Although I'm sure I said something like that. I think I can unpack that pretty simply, less complicated than what I just did. All right, the world has been going on about supply chains. Supply chains we need to rebuild our supply chains. China manufactures, China delivers. We need to do our own manufacturing, our own delivery, our own labor, our own drilling for natural resources. Fine. So we need to become self-sufficient and less dependent on other countries. The supply chain connects us to China. Their goods go through it this way. Every supply chain in the world, if you run a business, you'll get this. Every supply chain in the world has another chain right next to it. It's called a payment chain. So every time the good changes hands, money changes hands. We have the payment chains. We have the cash registers, the ATMs, the SWIFTs. And if you can't pay your contractor on the spot, then business stops. Oh, I've got to change it into this, into that. We've got dollars, we've got SWIFT. And that's our advantage. Technologically, we have a network. We are the Uber. We deliver the goods. When you think about it that way, it sounds kind of cheesy to put it that way, but it really is. It's a network. We're the monetary pipeline. So one of our greatest assets globally, in my opinion, no one else has said this, but based on what's going to happen, I think they're going to say it, is that network, that plumbing, right? That infrastructure. And traditionally, the world views, in business, you view those as a cost. It's the cost of doing business, getting from point A to point B. Well, it's such a valuable part of the business, like your delivery boy, why not make it a profit center? Now, the profit center is this. You want to put your money here because it's a safe haven. You want to park your money here. You want to put your money into euro dollars or what have you. Well, we're going to charge you a transaction fee. So if the U.S. payment chain is a big ATM and people like to put their money in the ATM for safety, they're going to charge us to make, we're going to charge them to make deposits.
Do you see there being a risk to that in the sense that as that cost of doing business goes up for them, as well as the oversight of all of that information being in our hands and not in their hands, that'll push them quicker towards their own solutions?
Yes, it certainly is an incentive to go towards your own solution. Now, I think that's a really good question, because I think what happens is, because he makes these blanket universal tariff type of concepts, and then he individually negotiates bilaterally. So we're good friends. You get to use the ATM for free. You follow? So, and that's what he just did with the Saudis. Now, to make this in real economic terms that are not so analogy oriented, it's actually very simple. If they're going to charge us too much to give us their goods, then we're going to charge them too much to give them our money. So it becomes an ATM fee. And, no one's really talking about this yet. So I really appreciate.
But it does become a pass-through to the customers who are purchasing from China, manufacturers.
No. No.
I
That's
mean, as their
okay.
cost of business goes up, they won't embed that cost into the price of their products.
That's a banking cost. Okay, so I don't want to. I mean, I'm going to say no, generally speaking, but generally speaking, no. So, can they pass that cost on to customers? Not as easily. It's more like an ATM fee that's taken by the bank. Here, it's a really good question. Does that get passed on? Well, let's assume that a portion of nothing's black and white. A portion of it does, but by and large, what happens? Who suffers? The banks, the money changers suffer. See, all putting a market access charge is doing, in my opinion, is saying banks charge you for transfers. It's the government taking the bank's role. Okay, so when you buy something in another country with your money here, it has to flow through, and there's fees involved. Well, those fees aren't made by the bank anymore. It's kind of like I've talked about the gold trade, the carry trade. Well, now the government's going to do the carry trade. The government if you're libertarian, it's not good news. The government is centralizing revenue models. They're taking and to that question and your point, this idea was floated seriously in 2019 already. Now, it's not something that hits the mainstream because it's high level economics. I had to read a book to figure out what the heck it was. I read a couple papers, but really, what happened in 2019 is we suggested it to weaken the dollar. See, this weakens the dollar. To your point, is it going to slow down business in dollars? Yes, but unnecessary business, hot money's that's not coming here to stay here. Money that we could live without, money that constantly is getting parked to be spent on something later on. So it lessens our global reserve currency status intentionally, and it in the end, those people hold less dollars. Doing a money access charge, as it was proposed in 2019 and voted down by who? By the banks, who would lose the fees. So I believe that's coming back. And I believe when you see him reduce taxes on domestic transfers and start fining people, charging 5% to transfer your money to India or transfer your money to Mexico, well, he's starting that process. And that's a big asset.
Okay, very interesting. All right. I'm sure that you saw the U.S. Treasury's increased borrowing estimate of about $500 billion for the second quarter of 2025. It was driven by dwindling cash reserves, a $390+ billion upward adjustment from the February estimate. It was all indicating that there's ongoing fiscal strain, and it seems that it's much larger than anything that Doge can repair or offset. And also, the new big, beautiful bill that passed the House the other day calls for increasing the debt ceiling like $4 trillion. Right. So what are the likely economic consequences for the U.S. economy of increasing budget deficits instead of the decreasing deficits that were expected even just a few short months ago?
Yeah, that's right. There's a lot of coverage of the bill and how it's spending too much, and I'm not going to say it's too much or too little, but I'm going to say that first of all, to get Doge out of the way, I'm not going to say it was kabuki theater, but I am going to say it was a drop in the bucket compared to what we have to do, even if he could get it done. Okay, so let's put that aside.
Well, that's important. That's an important point. Even if he can get it done,
right? I mean, this is a nation of lawyers. I mean, we get all excited about it. If you believe in this, you get all excited about it, only to be disappointed. It's kind of like, did we go into Fort Knox? No. Where are the Epstein files? No. It's all related, but it was in the right direction. So at the very least, it slows waste down. So I applaud it. Not that I'm in a position to applaud it, but I applaud it. But moving to the bill itself, now I'm not going to debate it, but I've heard from two people that I think are pretty sharp on it. One said 4 to 5 trillion, like you said, and the other said really it's only $1.5 trillion. So, but actually Goldman Sachs said really it's only $1.5 trillion, and David Stockman and other people like yourself said it's 4 to 5 trillion, and it probably is 4 to 5 trillion. if we get
I'm going based on reports. I'm not going based on
no,
anything that I have intimate knowledge over.
no, I understand. I understand. Oh, don't worry. We're not gonna take you to the accounting firms and say you said no. I think that when you look at the 4 to 5 trillion, it has to do with it assumes. I think it assumes a worst case scenario in tariff revenue, and if you look at the 1.5 trillion, it probably assumes the best case scenario. But let's assume. So, and I'm gonna echo something I read by Goldman. Uh, let's assume the best case scenario for this conversation, right? But we're talking about, can we afford to increase the deficit? And that's what we're pushing towards here. Let's assume the best case scenario. Even with the best case scenario, we cannot afford to increase the deficit. Number one. Number two, the only way he could have done that without increasing the deficit, again, Doge doesn't matter. It's a symbolic drop in the bucket, would be to cut entitlements. And entitlements are Medicare, Medicaid, and welfare. However, I don't know what the word is, but
and probably and defense.
Well, he can't cut defense, and we can come back to that if you want to, but he can't. Net, he's got to spend more defense, and that's all part of making America great again. So anyway, we'll talk about that in a second. It's great stuff. I got this from a military guy. All right, so he needs, if he wants to get that 1.5 trillion to zero, let's assume that it's the best case scenario, he needs to cut entitlements. He needs to cut Medicaid and Medicare and a couple of other big things. Staying away from the military for a second, but he needs to cut those. And when he spoke up, remember the other day he said, and let's be clear, nobody's going to go after Medicaid, something like that. He said something to that effect.
Yeah.
Well, agree or not, for him to say that does two things. One is it tells the other Republican congressmen we're not going to give in. So if you're being fiscally conservative, we're not going to give in to you. And number two, it keeps him a little bit more popular because he needs. So he's definitely doing some horse trading now, and he's having some problems with it. So and now I'll bring David Stockman into it. Some stuff that I read by him. If Donald Trump, if the president is not willing to cut back entitlements at all, and there's two ways to do it. I don't even know what they are, but there's two clear ways to do it. If he's not willing to make the real cuts, we have to tighten the belt somewhere. And if we don't, then there's no way we balance the budget, which brings us to the alternative. If the spending stays at what it is, 1.5 trillion in excess to 4 to 5 trillion, whatever the number is, even at 1.5 trillion, one of three things must happen to make it work. And we're on this path. The first one is directly weaken the dollar, and that would be by lowering rates. The second one is, meaning we have to borrow more money, so you have to cheapen the debt. The second one is, and this one is more insidious or insipid, financial repression. So financial repression, it's a government term they use to hide what it meant from us. And all that really means is the Fed goes out and buys our own bonds. We're not there yet, but we are doing it. We're doing it we're backing into it. The government goes out there and buys our bonds or doesn't sell them when they should. And instead they take the money and they take the bonds that they don't sell and they print more money. So in simple terms, it's like instead of buying a 30-year bond, you borrow for 30 days. And so that's like cash. And so we're monetizing the debt. And that is a way to quietly envelop the consumer and the American citizen in inflation like a snake eating you from the ankles up. 5 years from now, it's 1977, and you're up to your neck being eaten by a python. The third way, and this is where I come back to Goldman. Goldman says we could actually get involved directly in the market, meaning use the plunge protection team, or exchange stabilization fund is the proper terminology for it. And in doing that, we would actually go in and legally manipulate. It's not manipulation when they do it, it's management. We would manage the currency, and in doing that, you would dislocate people harshly and quickly. It's like doing a layoff at a factory. It would really screw things up. So the answer is the sum of the whole thing is we're spending too much. He can't cut back. He's not serious about cutting back in a way that's meaningful. And in the end, if he keeps spending, which he has to, he says, right? If we keep spending, then we're going to suffer with chronic, prolonged secular inflation, not a 6-month path to making America great again.
And that looks like the highest probability pathway at this point, doesn't it?
Yeah. When you factor in your military comment, it gets even higher, Well,
let's reserve that for another episode. Yeah. But let's shift over to gold, Vince. The 1970 to 1980, since you referenced the 70s, that gold bull market saw gold prices rise like 2,300%. And the 2000 to 2011 rally, that delivered about a 650% gain for gold. But, of course, based on the equal purchasing power loss for the dollar.
Right.
The current bull market, 2015, we'll call it, to present, it's advanced roughly 300% so far. So It seems to be going down, this pattern of declining amplitude in each cycle. Should investors expect a proportionally smaller peak this time around? Or do you see the unprecedented monetary expansion post-2020 and the global monetary fragility that we see right now triggering a reversion to the scale of like a 1970s surge?
Right. That's an interesting question. Just thinking out loud, you can tell we didn't rehearse these. Just thinking out loud, if you look at the 70s, using the 70s as the bigger example, right, as you're saying, it's lower and lower peaks in percentage terms. You can make the argument that in the 70s, it was out of control for a couple reasons. And one of the reasons was there were no alternatives. There was no developed bond market. There was no ETF. There was no tips. There were no other safety valves. So you put your money in gold. Markets were less sophisticated and it exaggerated. You'd also notice that back then, when you measured it as a percentage of monetary float, M2, right? When you look at that, we went well above it. Like gold actually went above the monetary float. So you could definitely make the case that, first I want to agree with you, right? That's a solid case that we can make a lower high in percentage terms based on the past. And I'm giving you reasons why that could be true. Now, I agree with you. Now, I'll give you a reason why it might not be true. It might not be true because I think we have a tendency to measure in decades, or like where you pick to measure. What'd you pick? 2015?
70 to 80, and then 2000 to 2011, and then now 2015 to present.
Right. Okay, so let me use a different metric. For this one, if you measure from the lows after 2012, after the 2011 high, you get as low as like $1,200. So by that measure, we are up a higher percentage. Now the 70s to the 80s. I have no answer for you on that one. You know what I mean? Like,
I think part of the 70s to the 80s, there was a lot of pent up demand because, from 1933 to 1974, you could not own gold in the States. And there were many other countries around the world that prevented gold ownership to the individual citizen of their countries. And then that started to change. It changed in the States in 74, and then it started changing around the world after that.
That's right. I mean, it's like a new Apple store opening up on your block in the 2000s, Oh, let's get one,
Especially when you realize all the challenges that are happening with the dollar and inflation and everything else.
I totally agree with that. I think you can measure this. Michael Oliver does this a little bit better than me. It's actually his idea. If you measure the bull markets, I think by let's call him a true technician as opposed to me. I don't know if you are, but he said that if you look at the bull markets from trough to peak, They all three. We're in the third one now. The first two appreciated by 800%. And so he draws the line a little differently than you or I would. I'm like 70 to 82, right? I'm like 2000 to 2011. I'm with you on that camp, but he's got some reason to measure it differently. And he would say that the 70s measure bull market was 800%. I don't see where he gets it, but I have to look. He has a nice chart on. I have to look, right? And then the second bull market is 2000 to 2000. What did you say for your numbers for 2000 2011?
About 650%.
Yeah, so he has 800% in there somewhere. We have to look at it, right? So maybe it's 1999 to 2012. Who the heck knows? But and then after that, he would say that you extrapolate from here, and I think 8,000 is not a problem. Now, backing away from the measured move concept, which it's look, how else are you going to look at it these days? If you look at it through the 70s point of view, it's like Jim Rickard stuff, monetary volume, 20,000, right. 35,000, and that's not wrong. How
there's
else are you
a
going
case to be made? Yeah, there's a case to be made there.
Right? I mean,
all right, so you're familiar with Michael Hartnett, the managing director and chief investment strategist at Bank of America Global Research. He recently stated that he is a seller of U.S. stock market rallies and a buyer of gold dips due to all the stuff we've been talking about: mounting debt risk, central bank gold accumulation, shifting global monetary order, everything. Right. But he isn't the only big money manager saying this. Others like Paul Tudor Jones, many of them are echoing this same position. What's your perspective on Hartnett's position and reasoning? Are you in alignment with him? Do you believe gold is significantly undervalued and underowned? And as the market is rallying, consolidating, people are going to be taking chips off and moving to gold?
Okay, yeah. So let me answer the gold part first. Gold is definitely undervalued, but it's on its way to being properly valued. And that won't happen for a long time. I don't think it's going to happen overnight. I think it's like another 5 or 10 years of that. And I can elaborate on that. But I think the Hartnett and Paul Tudor Jones part is pretty important. The U.S. or the American exceptionalism concept is a strong dollar and strong stocks. And what Hartnett's been saying since late last year, and he dialed it up pretty heavily in January of this year. He's been saying that if you look at the world, we need to spend less. Whether we do or not is a different story. And everyone else needs to spend more. So Europe needs to rebuild itself. They need to make their own missiles. China needs to buy its own goods. They need to spend money. Japan needs to fix its own industry. So everyone needs to spend money. We need to spend money too, but we're pulling it out of all the military bases, out of NATO. So all these countries need to spend more. So the world is flipping according to Hartnett. And the Hartnett flip is this. Fiscally, we've been very sloppy, right? COVID was the obvious example, but we've been spending too much. Now we're going to spend less. Fiscally, Europe, to use an example, has been very conservative. They really have. I mean, to their credit or not, they really have. They've been cheap with their money. They've been relying on the U.S., not just for NATO, but for the euro dollar and what have you. So they now have to fend for themselves. And we have to heal and rebuild. So Hartnett's point is American business will shrink relative to Europe. Let's use Europe's business. So they're going to be spending money on, you buy a military company, you buy a missile making company in Europe to keep it simple, and you don't buy one in the US. Now we know that's not true, but that's the concept. So the concept is the American stock market is here and the rest of the world is here, and it's too far gone, and it needs to now it could equate by their countries coming up while ours goes up at a separate slower rate, or it could be meeting in the middle or us dropping. Who knows? Depends on if it's recession or inflation. But Hartnett's point is, and this is gold gets tied into this, is that emerging markets need to stand up and Europe need to stand up for their own selves while we lick our wounds and heal. And in doing that, we need to react to that by making a weaker dollar. Otherwise, it goes bad too fast over here, right? So we need to just weaken the dollar, the whole debt thing. And in doing that, if you're a foreign country, right, you're going to be buying more gold because the dollar is going to be weaker. So gold is going to be a hedge for our inflation, right? And because we're weakening the dollar, and their inflation because they're spending more. So it's very valid, and he's been very right. Now, in the short term, it's overdone because we're talking about it. It's not something I talk about normally, but we're all talking about it now. And if Paul Tudor Jones here's a little bit of insight. If Paul Tudor Jones is talking about it, he already has it on, and he wants it to go his way. That's what they all do, and that's not disrespectful. It's just the way it works. So I think this will continue to play out for years, but over the next 6 months, it's probably too much.
Yeah, ebbs and flows, consolidations, maybe some drops, but the trend is going up, is what you're saying.
Absolutely, yeah. I mean, we have to equate. You remember in the 70s, I mean, you're not as old as me, but you remember in the 70s and 80s, it was all about our factories leaving the country and wages going up for other people in other countries. Well, now it's like our factories coming back to the country. Now they're taking their factories back. And so that it's like the world is rebalancing from a corporate point of view after rebalancing from an employee view.
Yeah. Well, okay. Well, I want to welcome everyone tuning into this fantastic interview with Vince Lanci, professional commodities trader for more than 25 years, publisher of the Goldfix Substack, and adjunct professor of finance at UConn. It's been an awesome discussion as always. And before we wrap up here with our final set of questions for Vince, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the title of this report. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join and explore. And thanks again for watching the interview. Now, I'm positive you've been enjoying this back and forth conversation that I've been having with Vince as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Vince, you and I were talking off camera before about a lightning round. Let's finish off our discussion with that. I'm going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100, with 100 being an extreme buy, 1 being an extreme sell. And then give 1 or 2 sentences as to why you take that position. We're going to go through these as quickly as possible since it's a lightning round. So we'll keep it as brief as possible. All right. So if you're not covering or following the asset, no problem. Just let me know. We'll move on to the next one.
I'll just say 50. Otherwise, I'll have an opinion.
Yeah.
That's it.
All right. On a scale of 1 to 100, right now, gold, is it a buy or sell, and why?
65. It's not as high as I would normally be because I believe that there's going to be some solution or resolution in terms of trade that could knock it back down. I'm just hedging my own bullishness by saying that.
Okay.
Right?
Gold miners, 1 to 100, and why?
Gold miners. I don't own them, at least not as much as I want to. I'm going to say 70 to 75. I think it'll overperform gold over the next year. Excuse me.
Okay. Physical silver.
55 to 60. I think there's going to be some big harsh moves as people cover shorts. But I think the more time that goes on, the more time the banks have to accumulate scrap and cover their shorts. I think that the central bank buying has not spilled over into silver, and we will have our spikes, but it won't be anything more than a very volatile, difficult market to stay long in for the next year, not the next 10 years.
Yeah. We're just talking, over the next 6 to 12 months.
Okay, good.
Silver miners.
50, no opinion. I mean, look, no, 50 is not right. 90, okay? If you could show me a pure silver miner that's well run and there are some out there, I'd say that's a 90.
Okay.
I'm looking at those now. I don't have an answer yet.
All right. Copper.
Copper, that's a big battle. I'm going to say 60. It's non-committal, right? I'm going to say 60. I'm bullish, but only because of the themes that we just talked about. Rebuilding, redevelopment, 6 to 12 months. I believe that the macroeconomic environment for interest rates is going to be the wind beneath a lot of sales coming out. So maybe the Fed's not going to ease, but the rest of the world is going to.
Okay. Uranium, and it's an interesting day to be talking about uranium.
Uranium, I don't, there are times when I feel really close to it, but I'm not really, speculatively speaking, I'd say 90. But the reality of it is I don't know enough to have an opinion. The reason, speculatively speaking, because uranium is such a small component of how these nuclear reactors operate, they don't care. They'll just pay more. Right. I could just see it exploding if nuclear explodes because it's such a small part of their operation.
Yeah, I mean, if the cost of uranium went up to $150, $200, $250 a pound, it wouldn't matter. They wouldn't care.
Like all right.
Yeah. All right. Oil, 1 to 100, and why?
If you'd asked me a week ago, I would have said like 30. I'm going to say 60 now because I think the market for the next 6 to 12 months has priced in a lot of the bad news, and I think OPEC will now continue to slowly tighten its reserves. And as Russia comes online, I think the price of oil will go up if the economy stays well. I'm long oil producers. Okay. All right. So I'm long oil producers, not oil. That I express it with producers right now, not oil itself.
I appreciate that distinction. All right. The NASDAQ.
No opinion, 50.
Okay. The S&P 500.
Okay. The S&P 500 is 50. The NASDAQ is 40. How's that?
Okay.
The reason being is tech is overvalued relative to the broader market. That's my opinion.
Okay. Short-term treasuries.
Short-term treasuries. This is interesting, Paul. Short-term treasuries. I'd be 70 or 80, but only because if there's a deficit problem, they'll go up, and longer term will go down.
Do you like it for optionality in the event of a market decline to go shopping?
Yeah, I do, but I mean, who doesn't? Not to belabor it. I mean, when you say short term, do you mean under 2 years or 2 years?
Yeah, under 2 years.
Under 2 years? Yeah, I mean, that's to me that's a money market. I don't have a problem with that, right?
All right, long-term treasuries.
30. For the reasons we discussed, I believe long-term rates are going to climb. I believe they're going to be permitted to climb, if not clandestinely urged to climb, to fight the longer-term inflation. And I believe that even though the rest of the world is, currently, half of the world is de-dollarizing, and they're selling treasuries. And I believe over the next 6 to 12 months, treasury yields will go up as the Fed lets that happen. Not that they have direct control over it, and the market digests it. So I think the yield curve has to steepen again. So
then the budget deficit blows out, thicker as that goes on, right?
Yeah, that's the backup. Like the bond market is punishing, right? It's kind of like the bond vigilante concept. The bond market says, "Oh, you're not going to cut spending? Well, we're going to pay you. We're going to make you pay more for your borrowing." And that's what I think will happen.
Yeah. Okay. On a scale of 1 to 10, instead of 1 to 100, with each representing a percentage like 1%, 2%, and you can go halves and quarters, where do you see inflation by their metric, by government metrics, ending 2025?
2%.
You think it'll be at 2%?
Yeah.
Okay. All right. 1 to 10 probability, 10 being the highest. Are we headed into a recession before the end of 2025?
No.
So 1?
So
1 to 10.
1 to 10? So call it a 2.
Okay. So very unlikely that we're going into recession.
Right.
Okay. Understood. All right. And finally, answer this however you wish. The recommended portfolio for the last few generations has been that 60-40 portfolio.
Yeah. Uh-huh.
Spread out the way how it's spread out: 60% stocks, 40% bonds, mutual funds in the 60%, et cetera.
Right.
That's really changing dramatically, though. It hasn't hit mainstream, but most of the analysts and experts and the non-financial advisors who have the actual customers, they're actually saying we need to have a change there. And it has changed. The optimal portfolio allocation has changed. How would you describe for you what today's optimal portfolio allocation looks like?
Well, that's not fair. You have to tell me what they've changed it to. Do you know?
Well, I mean,
I know it varies. I'm not trying to hang you out.
You could use all the various asset classes, from cash to gold to commodities.
I got you. 25, 25, 25, 25. 25% in equities, 25% in bonds, 25% in gold and commodities. I'm going to put those together. Some people will say gold as one asset, gold and commodities. And then the other 25% is cash to be deployed in any of the other three on a dip.
Okay. So in the equities, are you 100% in the States or are you going international?
I'm going to stay in the States. And despite what Hartnett says, I'm going to stay in the States because that's not my lane. I know how that works. And there's international risk. And for crying out loud, if I'm not willing to buy a miner with overseas exposure, why would I be willing to buy a stock in a country that, Trump could tariff 50%? I'm staying right here.
Fair. All right. In your bond bucket, are you long-term bonds there or are you just short-term bonds? Or are you a mix?
Oh, it would be a laddered portfolio, probably going out from 5 to 25. Yeah. So
you would have some long-term bonds in there.
Absolutely. Yeah. But mind you, I have 25% in cash.
Right.
So it's not like 60-40. It's like, look, the bonds are going to do good sometimes. And when those times come, that cash gets deployed. And that cash gets deployed, I'm going to dollar cost average and take some money out of the bonds. If there's a depression or, a big recession.
I know what you mean.
Right? Deploy the cash, sell some bonds, that type of stuff.
Now, in your gold bucket, your gold and commodities bucket, are you buying any miners?
I'm very broad when it comes to that. So, I used to really actually study. Now, I know you have a lot of mining here. Look, I want to just share this a little bit. I have had a hard time finding miners that I know the management. If you don't know the management and you don't have the insights, okay, it becomes math, and the math is hard to deal with when you're in an industry that's that's suppressed by behavior of the economics of the market. Look, they're not pulling any metal out of the ground. They're a buy. It's a once in a 40-year opportunity for miners. Okay, I'm not buying miners, but I know what I need to do. Miners are at a once in a 40-year opportunity. Number one, the gold. You're looking at gold. The gold price is so high on the back end because of high interest rates. They can hedge their production going forward for years and make some big extra cash flow. Right. Number two, the shorts have covered, and everybody the bloom is off the rose for technology. Right. And number three, domestic mines are going to be preferred because international mines are going to be nationalized. So I'm having a hard time looking at that, and so I'm going GDX Junior. I'm going plain vanilla. And I know that I'm missing the 10 baggers, once in a lifetime ideas, but I also know that I've gotten burned by miners. And I don't mean like everyone's, the miners aren't going. I used to go to investment conferences and sit down with executives and talk to them and say, this is management, right? I talk to them and say, you know what? This guy is full of it. I can't buy that.
So what are you putting into your gold and commodities bucket? You got physical gold in there. What else are you looking at?
In the 25%, I'm putting, this is hypothetical. I'm probably in that category, but I don't want people to think that I'm, doing that. Of the 25%, it would depend on, there's discretion in that 25%. So the bonds, I told you, that's done. The equities, that's done. The cash, that's deployed. The commodities goes, I think we're going to be more inflationary. I sell some gold and I buy some oil. See, within the commodity bucket, commodities in general are a hedge for inflation, no doubt about it. But within the commodity bucket, gold is better in a recession. Oil is better in a recovery. So I'm buying gold when I think things are going to stink for a little bit. And then I'm rotating into oil. I'm dollar cost averaging between oil and gold. That's how I do that.
Okay. I appreciate that detail. All right. So, Vince, would you please share a key takeaway that you'd like viewers to keep in mind about today's economic market monetary situation, and then let everyone know where they could learn more about your work and how they can connect with you?
In terms of precious metals, I frequently have said the reset is a process, not an event. And we are in the middle of that process now. The gold market is going to restabilize the dollar lower, while it's going to restabilize against the yuan higher. So I believe that if you can be patient, you'll see that gold at 8,000 is not going to be a problem. Gold at 5,000 in 2026 might not be a problem. That's it. Gold is not an asset you buy to grow. Gold's an asset you buy to protect. That's what you should do. Where can they find me? Well, I have a Substack, as you mentioned, VBL Goldfix Substack. So Goldfix would find me. We do a morning broadcast. We put out a report or two a day. And we talk, it's a Big Ten approach to metals. We touch on miners, but I wouldn't say that I would come here for miners. But we talk about macroeconomics and geopolitics. And love to have you sign up for free. And if you wish to sign up for premium, that's fine too. Thanks for having me on.
Vince, I really appreciate you coming back on to Metals and Miners. It's been a lot of fun. I appreciate your generosity with your time, analysis, your ideas. I look forward to having you back on sometime soon. And everybody else, thanks for watching. I want to welcome everyone tuning into this fantastic interview with Vince Lanci, professional commodities trader for more than 25 years, publisher of the Goldfix Substack, and adjunct professor of finance at UConn. It's been an awesome discussion as always. And before we wrap up here with our final set of questions for Vince, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the title of this report.